This video is all about accounting ratios. This is incredibly boring, so I'm just going to go through the highlights and let you read through most of the formulas. Let's start with vertical and horizontal analysis. Now you probably already know this, but the way to remember it is vertical has a V, that's a big arrow pointing down, so that goes up and down the financial statements. Horizontal starts with an H that looks like a table, so you go across the financial statements for horizontal analysis. For vertical analysis, this slide looks kind of busy, but I'll just go through a couple examples of each. So vertical, the amount that you're concerned about is always divided by the largest number on the financial statements. So on the income statement, that's going to be sales. On your balance sheet, that's going to be total assets. So gross profit, for example, would be the gross profit of 120 divided by sales of 250. That's where the 48% comes from. On the balance sheet, if I cared about liabilities, I'd look at my total liabilities of 65, divide by total assets of 405, and that's where the 16% comes from. So you just go down the financial statements and change everything to a percentage. Horizontal analysis is looking at changes over time. So the only thing tricky here is you subtract 2 years and you always divide by the earliest year. So you want to see how things have changed since the earliest year of question. So for sales, you take the 250 minus 200 is a $50,000 increase. Divide by the 200,000, so that's a 25% increase that year. If I was interested in accounts payable on the balance sheet, I just take the 15 minus 10 is $5,000 difference. Always divide by the earliest year of 10, and that will give you a 50% increase. The one thing you want to remember on horizontal analysis is we have a problem with small denominators. And when you listen to the news, be careful when they talk about a rate of change. They'll talk about things like last year the product with the greatest growth was the sale of ukuleles, and that's because there once was 2 ukuleles sold and now there's 6, so that's a 300% increase, but there's still only 6 of them that have been sold. So be a little careful when you hear people talk about a rate of change to make sure that that original number, the earliest number, isn't a small denominator. The turnover ratios, they're really pretty easy. All the turnover ratios, whatever the name of the ratio is what's the denominator. The numerator is normally the income statement item most related to that ratio. So for total assets, you'd compare to sales. For inventory, you'd compare to cost of goods sold. So things that are at cost, you use cost of goods sold. Things that are at retail prices, you use sales on top. The place where you really see this is you kind of want to know how many days do you have things in your inventory. And so if you take 365 days divided by whatever turnover ratio you have, it tells you how quickly you're turning over your inventory, your receivables or your payables. Leverage relates to your debt, and so the debt ratio and the debt equity ratio, sometimes people will use those interchangeably. They'll call it a debt equity and really they're just doing their liabilities over assets. So this is one where terminology changes. You just really have to listen to your professor, see what it is they're looking for, or if you're in a meeting, go with whatever somebody says. Don't correct them if they call it debt equity ratio, debt to total assets. But most books call one a debt equity ratio, one a debt ratio, and one a leverage ratio. They're just different ways to see how much debt you have. Profitability. What you can do on an income statement is a common sized income statement, which just means you take everything as a percent of sales. So you see what your gross margin percentage or gross profit, or if you try to put them together, you have gross margin. Your gross margin percentage is that divided by sales. Profit percentage is your profit divided by sales. You can do anything divided by sales and come up with the ratio people care about. It's basically how much money you have left over after you pay whatever portion of the bills you care about. Same thing, return on anything is income, or meaning net income or profit, divided by whatever the name of the ratio is. So return on assets has assets on the bottom, return on sales has sales, and people will make up return on equity has equity. So whatever's on the bottom is on the bottom and your income goes on top. That takes us to DuPont Analysis. Some people just figured out if they took some of these ratios and put them together, they really are related, and that's what DuPont Analysis is all about. We've already talked about the ratios: return on sales, asset turn, leverage, and return on equity. And they noticed if you multiply them together, the sales in return on sales and asset turn cancel out. Assets on the asset turn and the leverage ratio cancel out, and lo and behold, you have the return on equity at the end. So rather than looking just at return on equity, they said let's split it out and look at all the components. It only makes sense if you look at an example. So I've got two companies here, one's a jewelry store and one's a supermarket, and notice they have exactly the same return on equity. But if we look at the jewelry store, they have a 40% return on sales, meaning they get to keep pretty much of the sales price, but a pretty low asset turnover, meaning they don't sell a lot. They don't turn over their assets, and inventory is a big portion of those assets. They don't sell a lot, but when they do, they get to keep a bunch. Whereas the supermarket has a low return on sale, not much markup, but a faster asset turnover. So they sell, hopefully, those fruits and vegetables a lot faster than that jewelry store will sell that diamond ring. Otherwise, we're going to have some stinky produce. So the DuPont analysis is just a way to look at how each company operates as you're comparing them, rather than focusing in on one number. That takes us to market analysis, and in your finance classes you'll learn all sorts of different ways to analyze the information, but this is just some of the more common ones that relate directly to the financial statements. The first one, you'll hear people talk about EBITDA, and that stands for earnings before interest, taxes, depreciation, and amortization. It's a way to take the net income off the financial statements and make some adjustments, some kind of quick and dirty adjustments, to take out some of the things analysts don't really care about. The first two are depreciation and amortization. Those don't involve cash, and Analysts often care more about cash flows, so we want to take those out. Interest they take out because you really don't want to penalize somebody for using debt financing versus equity financing. We usually look at how we finance the business separate from how we run the business, so we pull that out. And taxes are just because everybody has to pay them, so we just pull taxes out. And we're talking income taxes there. So when you hear people talk about EBITDA, it's just a way to adjust your earnings and get rid of some of those things that aren't relevant, aren't as relevant to a market analyst. The next one I want to talk about is earnings per share, because this is really way more complicated than the formula shows. In your intro classes, we'll have you use this formula, but in real life, in an accounting major, will spend 2-3 weeks learning how to do earnings per share. It's really a complex set of calculations. The good thing is, on all financial statements, the earnings per share, the correct one, is shown on the face of the income statement. It's required. So if you're really doing any financial statement analysis of a real company, use the number that is shown on the financial statement. And then we use that to come up with a price earnings ratio, where we look at the stock price per share divided by the earnings per share. And so it's kind of the number of times you have to pay, how many years the company has to be as profitable as they are now in order to make your money back. So this will change day by day as the stock price changes, hour by hour. And so it's a nice way to compare companies. Again, if I've got a $50 company and a $20 company, we can compare how much extra we're paying over and above the earnings of the company. So you'll see price earnings a lot on any website that you use to view company information. So there's a lot there. My head hurts, but you can always look them up in real life. If you have a quiz, notice the ones your professor wants you to know and memorize those.